Good evening, everyone. My name is Ivana Kotasova. I am a reporter with CNN in London, and it gives me great pleasure to welcome all of you here tonight at this panel on investment plan for Europe. As you can see, I'm joined by a very distinguished panel of experts, so tonight's discussion should be both inspiring and thought-provoking. I expect nothing less than being able to solve all the investment problems in Europe. To my right is Iliyana Tsanova, who comes from the very heart of the program, from the European Fund for Strategic Investments. To her right is James Watson, the Director of Economics at the Confederation of European Businesses. To his right is Olga Afanasyeva. She comes from the Ukraine Venture Capital and Private Equity Association. And last but definitely not least is Sebastian Płóciennik, head of the Weimar Triangle program at the Polish Institute of International Affairs. Welcome. The story of European economic growth has recently become more optimistic narrative. The European Union's real GDP has reached its pre-crisis levels last year, finally, after 8 years of near stagnation. And the European Commission is predicting steady growth this year and next. Another sign of a brightening outlook, the European Central Bank has finally ruled out interest rate cuts last week. When we look at the financial markets, the outlook is also very optimistic. Investors have been pouring money into European equity markets. Many of the major European markets have reached record highs recently. The euro is rising steadily. The once very fashionable talk about euro-dollar parity seems to be off the table for now, at least until the next Eurozone crisis. But when we look at investment, the story is a lot less optimistic. Investment in Europe has dropped 15% during the crisis, and we are still well below the pre-crisis peak. Unemployment rate is also still higher than it was before the crisis, and the jobs that were lost during the crisis have not come back yet. To fix this problem and bridge the gap between the growth and investment, the Juncker Commission came up with a very ambitious plan. The investment plan for Europe, which has launched more than 2 years ago, was aiming very high. The goal was to put Europe back on track and mobilize some 300 billion euros in investment. It promised to generate 15 euros for every 1 euro invested by the taxpayer and create 1 million jobs in the process. Now, the idea was that using this public money to guarantee investment would attract investors into projects that are perhaps too risky or not seen as profitable enough to bring investment in. So 2 years into the project, we're talking about expanding it until 2020. We're talking about enlarging the sum, the target sum, from 300 billion euros to 500 billion euros. My first question is to you, Iliyana. Where are we 2 years on?
Well, thank you very much, Ivana, for being with us and making this introduction. I will remind again what was the situation when the plan was put on the table. What we saw on the market was ample liquidity, at the same time a very limited appetite from the investors and the bank to invest. And this, of course, results in huge investment gap, very low growth, unemployment, and at the end of the day, it lowers the competitiveness of the European economy. So there was obviously a need of developing a solution that would address this market failure which was prevailing across the EU. And indeed, the idea was to find a body that will catalyze and mobilize these investments and put the ample liquidity into real economy. And the solution was indeed the Investment Plan for Europe, which has 3 pillars. The first one is EFSI, the European Fund for Strategic Investment, which is the financing arm. The second pillar is the advisory hub. And the objective of this advisory hub is to provide advice to private and public sector to prepare bankable projects that could attract the investment on one hand, and also to lift any capacity constraints that were limiting deal flow and hence investment. And the third pillar is a very ambitious agenda for reforms, and in one of the panels on the EU MOU discussion, we heard some of those reforms: capital market union, energy union, but also country-specific reforms which have to be tackled at the level of the member states to improve investment environment. And the backbone of this plan, and specifically EFSI, is a public guarantee from the EU amounting to 16 billion, which would enable the biggest bank, the biggest international financial institution, European Investment Bank, to invest in riskier projects, which it wouldn't really be able to invest without having the public support. And the public objective is to mobilize 315 billion of investments within the next 3 years. Actually, our deadline expires on the 4th of July 2018. It's an innovative instrument because it, first of all, represents a paradigm shift in the way public resource is used. Instead of a one-off grant, to use it to mobilize investment and tackle market failures, which are indeed limiting growth. Where we are right now, we have approved more than 500 projects, and we expect to mobilize 194 billion, which is 62% of the target. But of course, there is a lot of work to be done. We had to really learn by doing, we had to adjust the whole model because, as you correctly mentioned, Europe is back on its recovery track, but there are still investment gaps in certain areas. There are specific problems which differ from member states to member states, so we have to adopt a more tailor-made approach to address those country-specific needs.
Sebastian, over to you. What we've discussed in the green room just before, Europe is looking like it's coming back. Do we need a project like this? Do we still need to be injecting that extra into the market?
Okay, thank you, Iliyana, for this question, because actually we need to understand this program, we need actually a broader political perspective. And using a language of political persuasion, we can say, okay, this program was a great success, because look, we started 2 years ago, and now we have growth of 1.8%. In the Eurozone, but in general in Europe the situation is much better. And since that time, when we started discussion about this kind of program, 10 million jobs have been created. But of course, we must be very cautious with such quite simplistic evaluation, because the growth in Europe, in the Eurozone as well, has much more complex sources. And saying that, I don't want to criticize this program because there were and they are still quite important points. First of all, we need to go back to 2013, 2014 and see the European business in a very depressing mood. You know, there was a lot of pessimism at that time in Europe about growth prospects, about the chances to overcome the crisis. And this program was a kind of like a wake-up call, right? So wake up, go outside, there is life out there. Wake up your animal spirits again, the Keynesian feelings, right? To invest in Europe. You know, it was not that obvious at that time. So this is the first point. The second point is that, you know, at that time there was a lot of criticism towards the Eurozone management that it's entirely focused on the German way of thinking, in austerity. So cut expenditure, save money, do not spend too much. So this very traditional ordo-liberal approach, which dominated from the perspective of France, for example, Italy, Europe. So for them, it was not the Europe in economic terms. So this is why they were struggling for this kind of program. And I got it. I think politically, this decision balanced discussion about the European economy in total. And you know, from the Central European perspective, because as you mentioned also, the economies are different. But for us, this program is a chance to speed up transition from the, say, early transition model, which was based on low-cost competitiveness, which means we attract investment only because of low costs. And this is the way how we integrate into global chains of production. This program is a chance to start the transition into higher value production, which is already there in many branches. But you know, to catch up with most developed countries, we need a lot more. And this discussion is known under the banner the middle income trap. Pretty controversial term actually, but says that now countries like Poland, Czech Republic, Slovakia, actually the whole region, we are too expensive to afford not very advanced production. We need to move further. However, we still do not have branches, knowledge, newest technologies to really be in this A class. But you know, these are actually good points in evaluating this program. But there are also some critical points. I don't know if now we have a time or we can make it in the second round.
Let me get back to you in a while, because James, you were shaking your head when there was talk about austerity. So I don't know if that was just unrelated head shake or...
I mean, first of all, good evening, everybody. Well, I think I was just reflecting in a little sense. I'm not sure it was such a Keynesian plan in the sense that this, of course, was taking money from the EU budget that was already there. So in that sense, there wasn't an increase in expenditure on public money.
Yeah, that's a good point that we did not make. This money was not new money, right? We cannibalized other European projects to start this one. I don't know if everyone...
Yeah. I mean, and as Iliyana said, I think it's a great principle that we'd certainly agree with, the idea that moving away from grants, basically, you know, officials sitting in smoky rooms deciding which is the best project, to using the market to help the market discipline, help the market decide which project's going to be the best, and therefore as well leveraging public funds. So I think that was a great principle that we saw with the FC, and we'd like to, it's great that we're going to, you know, hopefully extend the FC, and I think that's a principle we'd like to see extended as we move into a new multi-annual financial framework more generally. It's of course a little bit disappointing, I think, that money was taken from the competitiveness areas around Horizon 2020 and Connecting Europe. We'd have preferred, as I say, the money to have come from elsewhere. So coming back, if you like, to the question of where are we 2 years later, I think Business Europe, we always said that, you know, you mentioned, of course, it's in 3 parts. We always said that, yes, we support the FC, it's a great principle. But for us, the part that was really going to drive investment was the third part about the reform agenda. And you mentioned quite rightly things such as, you know, completing the EU single market in areas such as energy, completing EMU, strengthening EMU, and of course the country-specific reforms. So that's the area I think there's still more work to do. Just again, to come back with a little bit of context. I mean, Sebastian talked about the link between the investment plan and growth, and you quite rightly said, you know, we have to be careful there. I'd even say we have to be careful linking the investment plan to investment numbers, because there's clearly a lot of things driving investment. So yes, as you said at the start, we're seeing a pickup in investment, but as a share of GDP, there's still more to do. By our calculations, at the current rate of closing the investment gap that we had pre-crisis, I think it's going to take until 2024 until we've closed that gap. So yeah, it's been a great start, but clearly much more to do.
Olga, I'm going to come to you in a minute. I just want to get Iliyana a chance to respond to that point of this money not being new money and being taken away from other projects, namely the Horizon 2020, which has been very successful project, one that almost everyone knows about. That's the one big flagship program. So what is the justification to take money away from that and put them into this specific, more risky project?
Well, indeed, the sources for the guarantee came from different sources which were existing, like Connecting Europe Facility, Horizon 2020, and others. And there was a heated debate at the Parliament whether that's justified, obviously. But I think if you look at on the other side, what it allows us is to develop a very concrete matrix of policy objectives. These are the priorities where we need to invest to achieve that growth, and this is innovation, R&D, infrastructures, small and medium enterprises, etc., with the right products and instruments to respond to those investment needs. And by mixing budgetary guarantees and cash resources in a big scale flagship instruments allows us to have such a bigger impact than if you use smaller initiatives which are a bit fragmented. And I think we can see it now from the implementation to date. The good thing also about EFSI is that it allows the money to go where there is a demand. We still have, of course, some caps in terms of geographical concentration and sectorial concentration, but it is a market-driven instrument, and we invest where there is a demand. We invest in a number of risk-sharing instruments to allow banks to lend more to SMEs. I mean, if you look at countries, especially in the new member states, where the businesses complain that the collateral requirements were too high, the pricing were too high, we changed the game, the rules of the game by really lowering those interest rates and collateral requirements. We have invested in very risky R&D projects in key European companies to enable us to compete with giants like Google and Amazon and others, other players in the US and Asia. And I think we are achieving, we are on track on achieving what we are supposed to achieve. But there are still issues we need to really think about in terms of how we can mobilize more private sector funding, how we can indeed fill capacity gaps in those member states that are not that successful in coming up with investment projects which could attract EFSI funding and also from other sectors.
Thank you. Olga, you work with investors, you work with small, medium enterprises, high-tech, innovative companies. This program is very much trying to target, that's one of the big goals of this program, is SMEs, startups. So what do these investors need from a program like this? Is it targeting the right segment? Is it, you know, is the setup what investors in this segment need?
Yeah, definitely. Thank you for having me, first of all. And I would like to probably firstly step away a little bit from what we're discussing and to speak from the point of view that not what Ukraine needs, but what Ukraine can give to...
Right, let's get to that a bit later in the discussion. Let's just stay on this topic. So I know you work with investors coming to Ukraine, but if you could just kind of summarize what are investors looking for? What are the main advantages of taking part of in a program like this? So, you know, the goal was to try to lure investors into programs that are a bit more risky than they would otherwise go for with this public money guarantee. Is it working? Is this what investors need?
Yeah, definitely. And well, the fact that fund of funds are creating, which makes the public money and private money, is the proof of this fact, definitely. And private investors kind of afraid to risk with all their capital, and they definitely need this support from public funds, EU funds, and so on. And high tech is the sector which needs more of this support indeed.
So on that point, to everyone on the panel, one of the criticism of this program is that the risk profile of the programs that have been financed or are being signed is very similar to what European Investment Bank would have financed anyway. Iliyana, you're shaking your head, so let's give you the first chance to reply to this. What is your...
Well, it's all relative. I mean, if you look at the perception of risk of an equity investor and a bank, then you could hear different stories. But if we go back to EFSI, we have a very strict criteria which we examine closely where we evaluate the projects. First of all, we have an investment committee which is independent, consists of independent experts, and we have two important aspects of a deal. First of all is additionality. We have to justify that we are financing projects that we couldn't have financed to the same extent if we didn't have the guarantee. And the other aspect is eligibility, meaning to what extent the project is in compliance with the EU policy priorities, employment impact, climate impact, whatever. So when we examine those criteria, we have to ensure that we crowd in private sector, not crowding out, that we are indeed financing projects which are sub-investment grade according to the EIB credit matrix, and second, that we are in compliance with those eligibility criteria. And indeed, you could hear criticism from external parties that we are doing more of the same. I don't think so, and I'll give some data to support that. European Investment Bank, before having this public guarantee, invested only 5%, approximately 3 to 4 billion euro a year, into the so-called special activities, sub-investment grade operations. Everything else was, relatively comfortable risk. And now, as a result of EFSI, we have increased these investments 4 times. Now, I think close to 25–30% of our business is in sub-investment grade projects. And also we have 2 out of 3 of the clients are new clients to the bank, which means that we are taking risk. We have developed new products to allow us to take these extra risks like risk sharing, quasi-equity, subordinated instruments, exactly to be able to meet the target set in this particular regulation to achieve the targets that EFSI has.
Anyone else on this point of the risk? Are we selecting the right project?
Okay.
Sebastian?
So I think this program now is in a kind of warming up phase, because this is the first edition, and we expect that the program will be developed and kept further and developed further. And in the next edition, I think we definitely need more risky orientation of the fund. Because even going through all the proposals which are in the recent report published in May, you see actually quite obvious investments, many roads, many energy projects, actually quite traditional, not radical green projects. This is one of the points of the criticism, right, towards this program. But in fact, what we need is a kind of, when I look at the model of the United States, DARPA, which is, they accept losses, almost up to 80% of investment capital. But simply basing on the assumption that the rest 20 or even 15% of the projects will deliver huge change in the American technological system, right? So Google, also Tesla, these companies were supported by this kind of means. And it's hard to expect from the private business that they invest in such crazy ideas, because if the risk of losing money is about 90%, they need to be heroes, right? But the states can afford such losses, simply to create such fund. I think this might be a good orientation for the program, because so far there are quite justified doubts, and Bruegel published last year a report about it, that there is actually not so much difference between the investments supported from the program and the traditional programs of the European Investment Bank. So where is this added value, right? So is that only money added to the program? So this is why some experts come to the conclusion that this is actually a hidden fiscal stimulus, right? Not really a game changer on the level of technologies and investments in Europe. And the talk about more risk-oriented investment is not that well funded.
James?
Yeah, I'd agree with Sebastian there. I think the FC in a sense has been given quite a difficult job to do because it's got this 325 billion target, and we all know it's quite a high level of leverage. So if you think about what the FC is trying to do, it's trying to attract projects that wouldn't be wouldn't have been available that wouldn't have been financed normally. But as well, it's not trying to invest in those that would have been financed. So it's got a sense, it's just that projects that almost got over the hurdle, if you like. So it's got quite a narrow window, which is really a result of this quite high leverage rate it's been given. And in line, I think, a little bit with what Sebastian was saying, it might have been better in hindsight if we hadn't had this great political target of 325 billion. And the EIB, the FC, had just been given, an amount that they're able to put at risk, and they had a little bit more flexibility to put that in the projects where they really thought, that they were complementing the market. So, I think that might have been more helpful. I should add as well, I mean, the additionality issue, and it's great that actually a number of people, in particular, I think the European Parliament has picked up on this very quickly. So, we're seeing quite a lot of scrutiny on this, which is great. I would just add, additionality, the danger, of course, it's not just that we use public money for things that public money could be better spent on, but it's also the fact that if you essentially crowd out the marketplace here, so there could be areas where you're developing, the market itself is starting to develop new financial products. If FC comes along and basically buys all the bonds that are available in that market, then that really reduces the way that the market is growing organically. So it's not just about public money, it's about making sure that we don't destroy the organic creation, if you like, of nascent capital markets in this area.
Did you want to make another point?
Yeah, just maybe a short add also, about expecting from all this investment that they will work well also in the future, right? In some textbooks about management, you can find from time to time an anecdote. How to call a failed short-term investment, long-term investment, right? And if you add the word strategic, then you are completely secured, right? And when we turn it up a little bit, then we can say even that investment that worked today, supported by the program, we'll see in 10 years what kind of surplus or added value will they bring to the European economy. Right?
That's all very interesting. Let's move on to the other pillars. One of the big things is the reform, trying to make sure that investors see stability in Europe. So let's broaden it up. Olga, I know you're keen on speaking about your country. So, we see a lot of instability in Ukraine, but also in many European Union countries, specifically when it comes to regulation. So one investment sector which has seen a lot of change in recent years is energy. So subsidies change as governments come in and out, and investors just don't know what to expect. So what kind of reforms do we need on the European level, on an international level, to make sure that investors have that kind of security they need when they're coming in with investment?
Well, actually, the reforms are really being made, and in terms of investment market and in terms of the whole country. And the evidence for that is like that no visa-free regime, DCFTA, and decentralization, deregulation, all these things. And well, basically, I would like to speak from the point of view, as I mentioned already, that we are more stronger than there is a perception about Ukraine, and we have more potential, and we already implement this potential. By we, I mean our companies, our enterprises, as well as investors from Ukraine and from abroad do see it and do invest in Ukraine. And well, speaking about the investment plan for Europe, this seems like the key to solving social and economic problems, and Ukraine can really contribute to solving these issues with solutions that are really scalable to Europe and to the world as well. And among the examples, I would name like defense, including cybersecurity. Ukraine sometimes called as the country of like good, like positive hackers, and this can really positively affect on what is needed for Europe, for instance, and for the world as well. Also, there is agriculture, there is energy, there is healthcare, and the intersection of these sectors with technology, which is very strong in our country, can really contribute to Europe with this project. Speaking about investment plan, Europe also needs to, Europe literally needs two things: the quantity of this project and as well as quality of this project. And in this context, Ukraine is exactly one of the countries that also can contribute in both of these things. Just a few examples. For now, for the date, we count about 3,000 and even more innovative companies, by which I mean startups. And also we have plenty of ideas and 100,000 IT specialists, IT professionals that can really implement these ideas into life. So with tech excellence and with lots of quality, we can give a great input to what Europe may need. So Ukraine can contribute to European leadership and competitiveness, both in quality and quantity.
Any thoughts on the reforms and how to ensure stability and continuity?
Well, when we talked to investors at the beginning of about 2 years ago, trying to find out what are really the obstacles to investment, we identified two types. One was financial barriers to investment, and we know why. The banks were subject to very strict regulation, they were not lending, and etc., etc. So we had to do something on that side to share the risk with them, provide them a capital relief so that they can expand the lending to companies. But then we had the non-financial barriers to entry, which were uncertainty, political instability, regulatory obstacles, things that are really in the hands of politicians to make it better. And we can also observe, even from the result of the investment plan, that countries that rank higher on good governance, doing business, are also able to attract more investments than the countries which are on the lower end. Therefore, the reforms are absolutely vital to address the needs of a country. A financing arm, a financing available will not really provide sustainability in the long run. It will have some impact, but it's going to be marginal unless you really fix the thing on a broader scale. And what we have now, one of the debates is for the next MFF, is there a way to link reforms which are prescribed in the European semester annual recommendation to funding from the EU budget? This will be an interesting debate, and I'm looking forward to it, but there are really ideas to provide positive incentives to countries to receive more if they deliver more on the reform side, and I think it makes perfect sense.
Sebastian, how can we help countries that are struggling with the stability to get investors into their countries? How can we help them?
Yeah, it's a difficult issue, and also an issue that might become a political problem. Because if you start arguing that, well, this program contributes to more asymmetries within the European Union, just like this discussion, about the Eurozone, that economic activities concentrate in the centers, right? So this program, because it's open and criteria are universal, applicable to everybody, all countries, then actually the winners are countries which are much better prepared for that kind of competition, and they have developed capital markets, good banks, ready to deliver capital, and countries in Central and Eastern Europe, and also to some extent Southern Europe, they do not have such possibilities. So how can you help them? Assuming that you are not able to develop such a well-functioning capital market very quickly, and not changing the rules, right? So I think, well, there must be, maybe the first point, there must be focus on transnational projects. Maybe this is the way how to integrate countries from the peripheries to such a program and to more equal distribution. But you know, this is difficult because you need to develop a great idea for a transnational project. So far, I don't see so many of them, but let this imagination give to investors. Help of the European Union to develop capital markets, and I think all these reforms you mentioned also, you know, the digital market and capital market and single market reforms, all these reforms will contribute, hopefully, to a situation in which also countries from the peripheral locations will have more chances to get the money. However, I don't think that this is a feature of the program which must be criticized so openly, that there's unequal distribution, because it creates some pressure on the countries in peripheries. Okay, we are weaker, we have less capital, not so good banks, so maybe we should be innovative. But innovative in terms of institutions, how to develop new institutions which will deliver this capital, right? So this is a kind of pressure maybe we need in this program, and from a disadvantage we can have at the end an advantage.
Sure. You wanted to?
No, probably.
Right.
I just wanted to complement what Sebastian said, that part of the program, and I think a very important conditions for success is the cooperation with national promotional institutions. These are either development banks, national development banks, or fund of funds, or other institutions that have a specific mandate to tackle market failure or to achieve a specific goal, whatever. And by cooperating with those agents, both on the advisory side and also on the financing side, we are much more successful to design investment platforms, to reach out local clients, address market needs, which are so country-specific and which we can't address if you have one big instrument being managed in Luxembourg. So cooperation with national promotion institutions for us is absolutely vital. Support to designing and creating tailor-made investment platforms to tackle investment needs in specific member states is now a top priority, and that's going to be legalized with the approval of EFSI2. And I think going forward, when we talk about post-2020 multi-annual financial framework, those national promotional institutions will play a very important role to absorb investment and provide the investment in the local, for the local needs. So I think it's important to build the capacity of those institutions now so that we are ready for the next 2020 to really give it a big go.
James, from the point of view of European businesses, what reforms would you like to see?
Well, I mean, the first issue is really around political uncertainty. We were doing our forecast in the autumn, and we wrote a list of countries where there was political uncertainty, and you know, we ran out of room on the page, quite frankly. Some of those countries are still on the list, if you like, but a significant number of them, as we know, have dropped off. And sometimes, you know, even in Italy, where, if you like, the referendum went the wrong way, the fact that we know what came afterwards, sometimes it's the uncertainty of not knowing how things will work out, and even seeing the bad outcome can almost be better than the uncertainty. So as we all know, Europe's in a much better place politically than it was 12 months ago, and that's very important. That's very important for investment. So there's this overall story about political uncertainty. And then I think we can talk, if you like, about sectoral policy uncertainty, and particularly, you know, a large proportion of these investments we're talking about are in the energy sector. The energy sector is a sector with an extremely long lead time, and the certainty of knowing, for example, how the carbon market is shaping up, how policies are shaping up there for the long term is extremely important for long-term investors. So there's a sectoral policy uncertainty, if you like. And then I think there are broader issues around creating that attractive business environment, and that's very wide-ranging. I think labour market reform, we know that's very important. We need to encourage, have a variety of contracts that really encourage employers to take on new workers. We've seen in Spain, we saw some labour market reform there. It's been incredible. I think even the greatest optimists have been surprised at the extent to which Spanish employment has increased. Let's hope. I read it on the way over today. I saw that employment last month had increased for the most amount over a month for a long time in France, which demonstrates, the confidence that can be built there by the expectations of reform. Clearly a need to deliver on those reforms. So, more labour market reforms or new labour market reforms in a number of countries. And then, broader issues around the business environment, better regulation. Taxation, I think, still an area, I think the EU, the record over the last couple of years has been mixed. We still have on the table, of course, a financial transactions tax. If the priority is going to be investment, I'm not sure how that fits into that narrative. As we saw this week as well, the EU going alone in terms of public transparency of corporate tax information, going ahead and potentially breaking an OECD agreement there that could be counterproductive for transparency, but also has the potential to put the EU companies at a competitive disadvantage. So still lots to do on that agenda.
Olga, to you, speaking of uncertainty, there is certainly a lot of uncertainty still in Ukraine. So what do investors need to know? How can we help them? How do you attract investment into a country which is struggling with so much unknown?
Yeah, my first comment would be to the note that there is this perception, of course, about Ukraine, and that investors kind of afraid. Well, some of them do afraid, but still we have the growth in number of investments and the number of funds that do invest. Most of them are not literally from Ukraine, basically. They are from US, and there are also European and even Russian funds that do invest in Ukrainian innovative companies. And the number of them is growing. For instance, during last year, the newly established fund of HP, previously Hewlett Packard Company, their new VC fund was just emerged, and in a month they joined our association, stating their decision to invest in Ukrainian companies, and I know that they are looking at them and planning to close the deal. So this is just one example. Basically, talking about innovative companies, they deal with technology, and IT literally exists in the cloud. So if something is happening to Ukraine, some political instability, it is not that risky. I mean, the risk is much lower than to invest in plants, in another thing that you cannot just take and put for a moment to another place. And there are a lot of talent, there are a lot of opportunities, and during the instability and the crisis situation, there are more options and more opportunities to get profit in the nearest future because the competition is lower. I mean, there are less queues of investors waiting to invest their capital into companies. So it is there are much more opportunities to get good results in the nearest future than in a stable situation when everything is fine and there are no risks.
Any response to that? Yeah. Right, I can see that we have some questions here on the screen. Let me tweak them a little bit because I'm the chair, so I can do that. The first one is on who will pay for the investment plan for Europe. So we've touched on that. We know where the money is coming from. But the second part of the question is very interesting. How do we ensure political accountability for the public resources invested? So one of the criticisms of the program is we don't really know how the decisions are made. Now the question is, do we really not know or do we not understand because it's such a complicated matrix that you guys implement there? So is there a room for improvement on the accountability and transparency in the next phase?
No, you cannot plan investment. These are quite often things that are unpredictable, and you are not able to design criteria of selections for good investments, right? For future-oriented investments.
I'm sure you disagree with that.
So I'm pretty skeptical here. I think that we should simply step back and stop designing, you know, a huge house of rules and institutions to control that. Because in this way we won't be able to create investment. And you know, I'm also innovations, and I'm also quite skeptical if always it has to mean that we need to spend a lot of money. I remember a project of DARPA. The question was how to produce quite cheaply a huge LCD screen. And who won was a person who simply bought LCD panels from mobile phones and connected all of them. So it was not a matter of printing such a huge square, but to combine, you know, something that is existing, but in a new, innovative way. So I'm not quite sure if that rules will help. But maybe, you know, just touching the question of who should pay for that. Some suggestions are formulated in the recent reflection document of the European Commission on the future of the Eurozone. There is a quite specific pot for the Eurozone called support for investment in times of crisis. There are actually three funds. One is for unemployment insurance for crisis-ridden countries. One is for investment, because in the crisis you have investment gap. And the third one is a kind of fund for rainy day. And I think the second one is actually something that might be connected with this idea, but it means also that the European Union, the Eurozone first, will have to decide for separate sources, revenues for such a fund. Whether it will be contributions of member states or a part of tax, for example, VAT. Because, you know, that story we have here is maybe a little bit strange. You know, I found such a description of this program. Put no cash down, first. Second, issue a small guarantee. And third point, wait for a yield-hungry private lenders to work the magic of leverage, right? So this is working now. It's okay, this is this warming up phase. But in the future, I think we won't survive this program, won't create a long-term perspective for this program without own revenues.
One point on that is the situation in Europe is changing quite rapidly, and we may soon be entering an era of higher interest rates. So how do we make this program attractive to investors once we get to that stage? And we're already getting to that stage in the US. Maybe James, is that something you'd like to address? Oh, you look very shocked.
Well, I mean, in a sense, one of the I mean, you'll know better than me, but one of the challenges facing the EIB is the fact that we've been flooded with liquidity. So the ECB has been providing, you know, very cheap liquidity for the last X number of years, which is something, of course, which the EIB can do as well. So in that sense, potentially higher interest rates not good for investment, but might be positive for institutions such as the EIB or the EFSI, and provide them with a greater role in that sense. But I mean, you'd know more than me.
Well, if you allow me to go back to the
Absolutely.
first question on political accountability, I think it has two aspects of it. One is governance, and the other one is transparency and accountability. And in terms of governance, we have a dedicated independent governance structure put in place. It's myself and the managing director, and I'm accountable for what we do because I've been voted by the parliament after a public hearing, and I've been put forward by the steering board of the fund. Then you have the investment committee, which is again appointed by the steering board. And then you have the European Parliament that have, at the end of the day, approved this legislation, and they adopted this particular idea. And on the other hand, it's transparency. We have to be transparent when we take the decisions, and we have to really explain on what basis we have taken these decisions, what is the rationale behind. And now, as part of FC2, once it is approved, the prolongation of this instrument we will publish the rationale of the investment committee for each project, together with the scoreboard, and this is a set of indicators for each project, which basically we evaluated and decided upon. So that's one. And the other question is whether these instruments will be relevant for the years to come. To be honest, I think it's not a silver bullet, that's for sure, but it's definitely a step in the right direction for many reasons. The fact that we have now an integrated picture talking about financing, talking about reforms, talking about capacity constraints, the fact that we have such a flagship initiative, I think it's absolutely fantastic. And yes, the environment is already changing. I mean, what we see now is that Europe is on recovery path, but the problem that we have is that this recovery is not even across all the member states. We have the old member states, if I can call them that way, where investment is more or less back on track. We have that group of countries like Portugal, Greece, Italy, where the public investment is 30% below the pre-crisis levels. I mean, imagine the backlog of investment and the impact on future growth and competitiveness of these countries. And then look at the new member states. They continue to invest in infrastructure, but this is because they rely to a large extent on EU structural funds. But if you look at private sector investment, it's not picking up. And if you have there are reasons behind that, need to deleverage, etc., etc. But if you look at even the nature of that investment, it's for replacement of machinery and equipment. Much lower part of this investment is for state-of-art equipment, which would put those countries and economies on the technology frontier. Second, you have problems with the fact that we don't invest enough in innovation, we don't invest enough in training, and this, for me, is a very worrying factor. So there are investment gaps, there are market failures, and we have to address those. Whether that will be this instrument or we will design new instruments to tackle these specific market failures, I think we will manage, but we will do that.
I mean, is one of the instruments simply relaxing the budgetary restraints that all the periphery countries have? That, I mean, if you talk about lack of public investment, surely one of the big elephants in the room is that they cannot spend more public money because they're being told to cut.
Indeed, but also when we talk about the investment plan for Europe and EFSI in particular, there are some exceptions to those rules, where if you have a public investment alongside EFSI under different schemes, then you could have some flexibility under those rules, which relaxes to some extent the fiscal limitation, if you wish.
Right, we have 2 more questions here, but I'd like to open the questions to the floor. I think we have a mic somewhere around here. Are there any questions in the room? No questions? Come on, people, you've come here to this beautiful room, I'm sure. Right, okay, no questions. Opinions? Not even that. Right, let's go to this one. I originally wanted to save that one for last, but since there are no questions, I give you a little bit more time to think about questions. I'm sure we can find at least one from the floor. Does the plan have the potential to secure sustainable growth and low unemployment? So let's focus on the unemployment. Let's focus on the jobs. That is one of the biggest problems, specifically in the periphery countries. I know it's very early on. We can't quite evaluate how many jobs have been created so far, but does it have the potential? Whoever wants to take that one. James.
Yeah, I mean, I think as I said at the start, essentially the plan is basically the right one. It's extremely broad, but it's essentially, if we look at the 3 pillars together, and in particular the one around the business environment and reforms, it is the right plan. The questions are essentially, firstly, is the EU going to deliver on its side? And in some areas it is doing, but I talked about the tax agenda, for example, just now, which is an area where we've got concerns. And then, of course, the second problem for the investment plan, if you like, is that it, as again we've sort of half discussed, it doesn't really have those levers because the reforms need to be done at the member state level. So, of course, we have the European semester. Perhaps we can do a little bit more at a central level to support those reform processes. You referred, for example, to public investment. We've said that we'd like to see the Commission look to see if there's any more ways that it could further incentivize governments to make those difficult long-term choices, long-term political choices, which they don't get thanked for essentially around public investment. Well, you don't get thanked for a long time. So is there a little bit more that the EU could do? Maybe there's a little bit more, but ultimately they're probably, the EU itself probably isn't going to have all the levers to really push forward the reforms that need to be done at a member state level. So it's the right plan from an EU perspective, but it needs to be delivered on one sense, and some of it's got to come from elsewhere within the member states.
I think we need to make a decision in the future whether this program is for macroeconomic stabilization and to ease, access for money to some governments in troubles, or should it be a program which will be able to make Europe a master in radical innovations. Because, my impression is that the European economy is specializing in the so-called incremental innovations. Pretty traditional products, like cars, machines, but not really high-tech products. And 2012, 3 American scientists, Acemoglu, Verdier and Robinson, published a pretty provocative paper explaining the transatlantic, say, technological community. They wrote that in the past, there was a kind of hidden deal between Europe and the United States. The United States was producing radical innovations, really absolutely crazy technologies. But the society, by the way, accepted a lot of risk, because for this kind of innovations you need a very flexible economy, hire and fire, capital on the stock market. Europe had access to products of this risky environment, so high-tech technologies, and imported that and integrated that with its industrial production. And for that, they exported to the United States well-educated labor force. Today, this deal is over because of demographic problems of Europe, and also because the economy is changing. We have platforms now on the global level which integrate production. For example, German companies of the famous Mittelstand are afraid that 3D printers and Industry 4.0 will kick them out from the global markets because everything will be controlled by the software of Google or Apple. And now the point is, Europe should stop thinking in this traditional division of labor, but to invest in its own capabilities to produce radical innovations. And this is at the stake today, and this program should actually aim at that. And in this way we'll secure sustainable growth and low unemployment in the European economy. We'll have both things, traditional incremental innovations and also radical ones.
Iliyana?
I will slightly disagree with what Sebastian said.
That's great.
That's all we want.
First of all, I don't believe that the fact that Europe is lagging with innovation is because there is no finance on the market. Actually, that's not the case. There is ample financing for research and innovation in Europe. The problem, as I see it, is a bit different. First of all, we don't have the venture capitalists that have the right know-how to evaluate a sophisticated, good idea from, a bad one. You have the traditional venture capitalists, but they don't really add value when we talk about new technology, radical innovation, etc., etc. That is why all these seed companies that we finance with seed funding at the first stage, they go to the US when they reach the next phase, because this is where you have the venture capitalists with the right knowledge, with the right know-how, that take you by the hand and they make you actually build your business and become a unicorn. We don't have that in Europe, so we don't have the know-how in venture capitalists for innovation. Second, the European traditional conglomerates, businesses, they are very risk-averse to purchase innovations from small SMEs. They just don't do it. And that is why the SMEs, or the small companies, they again go back to the US or Asia, where those traditional big businesses are much more open to explore and try new solutions delivered by smaller companies rather than a big one. and you have a market for them to throw. You don't have it in Europe yet. And this is where I think we need to really work more, because we have the financing, we need to have the know-how, and we need to also change slightly the culture of big traditional European businesses towards buying innovative solutions from small companies. That's what I wanted to
Olga,
tell you.
anything to add to that? This is very much your patch, small, innovative startups. So how can we make Europe really strong in this aspect and compete with the US? Sebastian seems to be very skeptical about that notion.
No.
I'm kind of agree with Sebastian, and when startups from Europe, out of Europe, want to raise the next phase, like round A, round B, growth stage, they go to the US and raise capital there. Yeah, this is true, and this is happening basically, some years ago in US, there were also so many venture capitalists with the expertise to invest in these startups, to assess the viability of the idea. But there was a support of government, and basically Europe has everything for that. So just need to risk more, to accept the risk, to invest in these companies, and try to grow this culture within Europe. There is the problem that the market is not that big as US one, and there are more early adopters in the United States definitely than in our countries. But the world is changing, and once we start invest, and once we start really believe that there are venture capitalists that are ready to invest in risky companies, then everything will be all right, and there would be local, like Silicon Valley here, and
I really like the talk about European Silicon Valley, and then the European Commission comes in with all these huge lawsuits against Google and all these guys. So is that even realistic to Europe has a very different culture when it comes to regulation, and are we really aiming a little bit too high? Should we focus on what we can achieve? Anyone? Sebastian?
No, I think the problem is first in creating a new culture of investment, as you said also. Because what we observe in Europe is actually not that sophisticated. It is called in textbook asset substitution. What does it mean? For example, when I'm an entrepreneur, I issue bonds or go to a bank and have a loan. And in this moment, there is a clear asymmetry and a situation of moral hazard. Because, I can now run my business to staff. And who will pay? Those guys who gave me money, right? But if I'm very successful, extremely successful, they have no participation in my additional success. Right? And this is the problem of the European capital markets and the European entrepreneurship in comparison with US, where you have this share. You have this is why, this venture capital is so booming there. It's working so well. And we need simply to implement slowly, not quickly, because it's not possible, but we should go into this direction. How to overcome this problem.
James?
Yeah, just one comment on venture capital, of course. When we talk about the US venture capital market, I think when you actually look at the market, you actually see that the venture capital is actually taking place in kind of 4 or 5 very distinct areas. So, for example, New York, Boston, Chicago, and the West Coast, let's say. So there's 4 very concentrated venture capital markets there. So really the question for Europe, and I think one that we've always struggled with, how do you, if we think about venture capital being very concentrated, how do we replicate that in a union of 28, 27 member states, where everybody, of course, wants to have their own venture capital market? So I think that's one of the challenges we've faced in the EU, which we might have to bite the bullet on. But I don't see something coming though.
I gave you some time to think about questions. Any questions from the floor? No. So I was told we absolutely have to finish on time because there is a wine reception after this, so we don't want to miss that one. I think everyone is already there because, But if we can wrap up, if I can have each of you look at the future, look at the next 5 to 10 years. think about what Europe needs in terms of investment and spend maybe 1 minute on this is the priority, this is where the focus should be. I think that would be a nice way to finish off. Who is the brave person to start with the least time to think about? Sebastian.
Okay, actually, I said before, you know, how the program should work in the future, in my opinion. But maybe
let's not be specific about the program.
Okay.
Let's look
about the dream, you
at
know,
the big
an idea
picture.
that should be financed from this program in the future, and it has a connection to Ukraine. A joint venture of European universities this joint venture will open up in Ukraine a university, a European university of, I don't know, Zaporozhye, for example, right? In, of course, cooperation with Ukrainian universities. This could be such an idea. Quite risky, without profit visible in the coming years. But it might be labeled as a strategic investment, right? In cooperation with Ukraine.
I think this was a pitch to you in investment plan. But Olga, what is your priority for the next 5 to 10 years in terms of what investment needs in Europe? What is it that we need?
What I've told, be more risky. Don't afraid and don't wait that the funnel would be like that. So invest it in 50 startups and 50 startups would succeed. It won't happen. It will never happen. This is the nature of venture. So be more risky.
More risky, Jim?
Well, we need to complete EMU. We need to complete the banking union. We need to strengthen the single market. I say strengthen because you'll never complete the single market. There'll always be new products that need to be looked at and regulating. Undertake the reforms I've talked about in member states. And underpinning that, I think, is recognizing that businesses aren't the bad guys that are just trying to avoid paying taxes, but they're the good guys that are creating wealth and jobs.
Iliyana, over to you.
I can only resonate with what James said, and to be honest, after the recent events with elections in key European countries, I'm really optimistic about the future of the EU. I wish we finish with the debate on the future of EU sooner, because this thing that is hanging now in the air, whether we will have a multi-speed Europe or not, is something that really creates uncertainty. And I think we need to really have these answers sooner rather than later. For the rest, I'm really hopeful that we will save our union and we will strengthen it for the future.
Right. Thank you very much. So to wrap up, we are very optimistic about the future as the panel. I feel there is a lot of positivity. We're optimistic about the future of the program, but we also think that there should be more risk-taking, there should be more transparency, we should broaden it up, we should look into how to help individual countries that might be lagging in infrastructure or admin power, and we should press on our governments to implement those key reforms that will bring in more investment. And on that, I think it's time for the wine reception, isn't it? Thank you very much.
Thank you.
Thank you very much.
Thank you very much.